Hey, Nick Vanderkar here. I'm with Eric May and Jeremy Durkin from Prosperity Mortgage. Thought we'd touch with them on some of the very regular, everyday questions that everybody has.
Okay, so
about
why don't you
mortgages.
two guys introduce yourselves?
I'm Eric May with Prosperity Mortgage. I've been in the origination business for going on 10 years now, primarily in the mainline area.
Jeremy Durkin, Prosperity Mortgage. I've been with Prosperity for a few months now, been in the business for 10 years.
So both these guys work for Prosperity, which is linked with Long & Foster, and they are both in our office in Devon. So guys, I don't know which one of you wants to take this, but pre-qual, pre-approval, mortgage commitment, all these terms get thrown around. What do they mean?
A pre-qual and a pre-approval are probably the same thing. A pre-approval is where you'll meet with a buyer and they will want to basically get financed or pre-approved for a mortgage. If they're getting a mortgage, it makes all the sense in the world to get a pre-approval first if they want to buy a house. So we'll basically get their information, name, address, social security, date of birth to run credit, check that out, get their income documentation, income numbers so that they qualify for the debt to income ratio, see how much they have in the bank for the down payment portion, and then we'll issue a pre-approval. We can usually get that done in about a half hour to 45 minutes.
Okay, great.
And the mortgage commitment would be the formal approval by the lender of the borrower's credit, income, asset documents, as well as the property through an appraisal.
Okay, and how long does that usually take? Obviously a little more than half an hour. I guess.
It depends on the specifics of the transaction. If there's a complete application up front, a couple of weeks to issue the mortgage commitment in most cases. And there'll be some miscellaneous conditions, routine items generally, follow-up documentation, title work for the property, verification of homeowners insurance, things of that nature.
Jeremy,
Great.
you mentioned this, but maybe Eric, you want to answer it. The process, what do you actually need to apply for a mortgage?
Traditional loan documentation, you can think of the rule of twos in terms of 2 years of tax returns. So in this time of year, summer of 2011, or spring and summer of 2011, that would be the 2009 and the 2010 federal tax returns, all pages, all schedules, along with any W-2s received those years. 2 months of bank statements in most cases. You'll want to have all complete monthly pages of each statement. If it's numbered 1 through 5, the lender will look for all 5 pages. 1 month of pay stubs. You know, a typical borrower that's paid bi-weekly, in that case you'd want at least 2 pay stubs to meet that monthly requirement. And you would want on those asset statements to account for funds to close on the transaction, where your earnest deposits are coming from. If you're receiving gift funds from family, those kind of things, to document how you're going to purchase the property, where the funds are coming from. If you're taking a hardship withdrawal from your 401k, or drawing from your checking and savings, or receiving some gift money from family towards buying the home, you'd want to try to document those things up front. Mostly it's about income and asset verification. It's also a time when a borrower can address any issues with their credit, such as if they had derogatory credit in the past, like a bankruptcy. You can supply that kind of documentation and a statement as to what the circumstances were.
Okay, Jeremy, credit scores. What do you need today to get a loan, and what are the differences for the different programs?
To get a loan today for credit scores, it depends on which type of loan you're going to be getting. On a conventional loan, you need a 620 credit score. Now, if you're putting less down on a conventional loan, the 620 credit score might not work. So if you're only putting 5 or 10% down on a conventional loan, you probably will need a 680 to a 720 credit score because of the PMI, because you're putting less than 20% down. The minimum on a conventional is a 620. On an FHA credit score, on an FHA buyer, you'll need about a 600 credit score to meet the minimum requirements, which would mean that you could buy the property for 3.5% down. Now we do go below a 600 credit score. We can go down to a 500 credit score, a relatively new program just released. In that case, they're going to be looking for compensating factors and other overlays, 10% down, other trade lines that you pay on time, a rental history, a very good derogatory explanation letter, If there's extenuating collections, you know, a lot of those things can kick you out from getting approved. But if you have the 600 credit score for an FHA, a lot of the times you're going to
Now, Jeremy, you mentioned right in there in that answer two things I want to carry on with. FHA or conventional, what are the differences between those two programs? What is a conventional loan?
Conventional loan versus FHA. A conventional loan is a Fannie Mae and Freddie Mac backed loan. An FHA loan is insured by the government, by HUD, by FHA. In a lot of ways, they're the same, but then they have a lot of differences in the guidelines. So that's why it's very important to, you know, take the time to speak with one of us about getting pre-approved. The credit scores are different. The down payment requirements are different. The debt to income ratio is different. Usually FHA will have looser lending guidelines than conventional for debt ratio and so forth. But there's other areas where FHA is a little bit more stringent, like on the property. Conventional is a little looser on the property. FHA might want a handrail for safety reasons or chip paint on the property. So they're all lending institutions backed or insured by the government, Fannie Mae, Freddie Mac, or FHA, with different nuances, slightly different things about each one of them.
Okay. Now, one of the things I'm sure people get confused about, they hear conventional, they hear conforming, non-conforming, and obviously those mean different things. So, Eric, do you want to take that and just explain what a conforming loan is and
Sure.
what the differences are?
The most common type of conventional loan is a conforming loan. As Jeremy indicated, those are the ones that are underwritten to credit and property standards set by Fannie Mae and Freddie Mac, which have that quasi-government endorsement if underwritten and eligible to one of those two entities. That's a conforming loan. Non-conforming loans would be mortgages that are conventional. They're not FHA, but they don't meet the requirements of Fannie Mae and Freddie Mac. The most common type of non-conforming loan would be the jumbo loans. Those exceed the size limit of what Fannie Mae and Freddie Mac can purchase or guarantee. In Pennsylvania, on one-unit properties, that'll generally be $417,000 for conforming limit. So if your mortgage is under $417,000, you'll generally find the lower interest rates if you can meet the requirements for Fannie Mae and Freddie Mac. If not, non-conforming would be an option. Non-conforming loans and jumbo loans tend to have higher interest rates because the banks keep those on their books. There's no government guarantee on those, so it's a little more stringent on the underwriting, but you can go to a lot larger loan amount, or maybe you need to do some financing structure that's not standard to Fannie Mae or Freddie Mac, such as title vesting and LLC. In that case, you'd be looking for a non-conforming loan with a lender that'll portfolio it on their books. And that's the main difference between conforming and non-conforming. Conforming is Fannie Mae and Freddie Mac. Non-conforming would just be directly funded by the bank, usually held on their portfolio.
Okay, that's great. One of the other things you mentioned, Jeremy, was private mortgage insurance. We always throw these terms around, PMI, but private mortgage insurance is what it is. But what is that?
Private mortgage insurance is insurance that covers on a higher risky borrower when a borrower isn't putting 20% down. That's for a conventional specifically. On a conventional loan, if you're putting 20% down, you don't need the PMI, is what we call it, private mortgage insurance. If you're putting less than 20% down, then you have to pay an insurance premium each month, which can be anywhere on a $200,000 loan, let's say, it would be about $130 a month, let's say. So it's a hefty number. Once you're able to show the bank that you have 20% equity, you're less risky, then you can get rid of that $130 payment. Now on FHA loans, it's required for 5 years on all FHA loans, depending on how much you have in the transaction. So most of the time, we try to get a buyer or borrower to go conventional if they qualify. You'll see the similar price range for an FHA. Now, if you're putting 15% down, the PMI is much less. If you're putting 10% down, it's a little less. If you're putting 5% down, it's a little higher. On a conventional loan, there's a way where you can take a higher interest rate to waive the monthly PMI. So let's say the rate was 4.75. You could take 5% and eliminate that $130 PMI payment,
Okay.
and your payment might only go up 60 or 70 bucks. So there is ways to eliminate the monthly PMI as well.
Okay.
That would be lender paid MI, trade up the rate for,
Yeah.
the lender to pay the mortgage insurance. The most common one would be what Jeremy referenced, borrower paid monthly mortgage insurance, where you see it as part of your monthly payment. Depending on whether it's conventional or FHA determines in most cases how many years you have that mortgage insurance, which is insuring the lender or the government agency behind the lender in the event of default by the borrower on the loan. Just a third option is single premium mortgage insurance on conventional loans, where it's paid lump sum at settlement rather than paid monthly. That's useful if you're purchasing a home and you have a seller willing to provide a credit towards some of the settlement costs. It's a tool you can use where the mortgage insurance is paid up front. You lose it out of your monthly payment costs.
Okay.
Housing's a little cheaper.
Okay. Points. Another one of those great phrases that you hear people bandying about. Buy your rate down, but what does that actually mean, and what is a point?
A point is generally prepaid interest on the loan in terms of a discount point, which doesn't mean that the lender's giving you a discount because you got a great credit score. What it means is you're buying down the interest rate by prepaying some of that interest in the form of a point. A point is 1% of the loan amount. So, let's say, going with the example, 4.75 is the no points rate on a $300,000 loan amount. You could spend 1 point, buy the rate down probably 0.25%. That point would be $3,000. So, that's another reason if you have a good pre-approval up front, you can talk with the lender and determine if points make sense. Generally, if you intend to hold a loan for a period of time, like be in the house 10 years or more, of spending a point or two at settlement, if it's in the budget, makes sense because you're going to recoup that in lower interest on your mortgage over the duration. The other classification of points would be origination points. Those are generally associated with costs to originate a loan and sometimes come into play on certain types of mortgages, or if it's funded through a third party via a mortgage broker. Sometimes the origination costs are disclosed as origination points. So discount points and origination points, either way, they're 1% of the loan amount. And they can be typically paid at settlement by buyer or seller on a purchase, or they can be financed into the loan on refinances in most cases.